Let's go to Jim Lacamp and Joe Duran, market watchers extraordinaire. Jim, is it your sense that good news will continue to be, at least as it's been redeemed lately, bad news? In other words, a big pickup in wage inflation, which would be welcome for a lot of workers, wouldn't be greeted favorably on Wall Street.
Well, right now, the chief concern does seem to be the uncertainty about rising interest rates and where inflation is going. I don't think inflation is going too far, too fast. If you look at wage growth and you look at the Atlanta Fed numbers, 3% wage growth. And to put this in perspective, in November it was 3.6, so it's not even as high as it was in November. The personal consumption expenditure numbers, those are the Fed. That's the Fed's favored measure of inflation. It's still running very low, well below 2%. So, yes, the market, in answer to your question, is going to be worried about this, but I don't think they should be. We think interest rates are going to end up on the 10-year Treasury around 2.9% at the end of the year, which is about where it is now. And so I think as we get through the year, we're going to see these fears start to calm down, and then the market will start to calm down.
You know, Joe, if we get past 3% on a 10-year note, I think it's just a matter of time. Then what? What happens? What do you think the markets do?
I think the markets, it depends how it happens. I think we'll hit 3% in the next few months, actually, as the micro effects of the tax cut kick in. I do think it will be temporary because we have a secular overhang, which is technology, and it's making it almost impossible for pricing to go up and for wages to go up, especially for less educated workers. But you do have this micro pressure right now, and I think if that occurs, it just makes equities more expensive in a relative sense. So I think what you need to prepare for is a new normal, which is higher volatility, lower overall rates of return on stocks for the next 10 years. They've been in double digits for the last 10 years. Probably unlikely. It's probably single digits, mid to higher, 6 to 8% equity returns for the next 10 years with much higher volatility than we've seen.
You know, people
and
are getting...
because interest rates are higher.
No, I got you. Jim, this volatility, whatever you want to see it, is shown across the board in all sectors. And I guess that's just the new normal, returning to what was the usual old normal. But for a lot of investors, it scares them off. What do you tell them?
I tell them this is more normal than not. I mean, look, after the market sold off, we went up 2,000 points, 2,400 points in 12 days. That's an average of 200 points a day. It's really normal when a market sells off after you've had a little bit of a correction for the markets to be volatile for the next few months. In fact, it wouldn't surprise me to see the market retest the lows that we saw a few weeks ago. That's normal. That's healthy. You need to remove excesses out of the market. But I do think it's what we're going to expect moving forward. This year we had last year with almost no volatility was unprecedented. And that's not what we should expect moving forward. There's a lot more uncertainty now about the economy, about interest rates, about inflation, about stock valuations. We think the market's going to be fine, but anytime you have a month like you had in January, up 7% in 1 month, you got to expect some volatility coming out of a month like that.
Joe, there are a lot of people looking at this and saying, well, the tax cut thing, they better bear fruit. And already there's a lot of complaining about companies that are spending a lion's share of that money buying back stock, not sharing it with their workers, even though it's unprecedented, the number that have done that. And they didn't have to do that. So I'm not here to make a judgment call, just saying that alone, I would think, would benefit the markets, wouldn't it? I mean, just the money companies are pouring back into themselves.
Yeah, and that's what's going to support the market for the next 6 months. It's what happens afterwards. We have now a $1.5 trillion expected increased deficit. You're going to have continued borrowing, and this talk of tariffs really dreadful for stocks. I think that is, if we go, tariffs are a zero-sum game. So I worry a lot if the talk about tariffs and protectionism picks up. That's about as bad a story as you could have for stocks. It's bad for inflation. In many ways, that talk is a lot more dangerous for the market than anything else. Taxes are great for the micro story. It's the macro story. And interestingly enough, what we are telling people, as I shared last time I was on with you, is to tell people, look, you have to own equities, but you have to be really careful with the debt side of the equation. I'm very concerned we could be in the midst of an unfolding of a debt bubble. And in that constraint, you want to own actual debt, the actual bonds, or you want to shorten the maturity. So I just tell people, Equities are not your bigger concern. I'd worry more about the debt side of the house.
But you sound real quickly, Jim, more bullish in that sense. I mean, that you're not, you see these worries Joe outlined, but you're not super panicking about it.
I think they're legitimate worries. I don't think they're a right here, right now problem. If you try to time debt cycle problems, you can be waiting a really long time. And in the short term, in the windshield, we have tax reform, we have corporate earnings that are accelerating, we have guidance from corporations that are accelerating. As mentioned, we have a record number of stock buybacks coming in. Merger acquisition activity is ramping up as well. So in the windshield, I think we look okay beyond this short-term volatility. But beyond that, of course, these debt cycle problems are problems.
All right, gentlemen, I wish we had more time. Unfortunately, we don't. But again, I always like to try to make sure we get someone who has a optimistic view, someone a little bit more guarded view, as these two gentlemen did here. Like you say, we always try to make sure we present that argument on the markets here, so you never miss out. We'll have more.